Hello, my name is Raquel Young and I'm a volunteer with CPA Canada Financial Literacy. It's a pleasure to be here with you today to talk about managing your finances in retirement. If you think about the time when you were first starting out in your career, the majority of people tended to work for one company until their magic age of 65. From then on, most of them could enjoy a leisurely retirement relying on government benefits and company pensions, even if they had very little savings. While we all know a lot has changed since then, many of us have worked for multiple employers, some of which don't provide pension plans. Some of us have retired several times as a result of downsizing or mergers. Defined benefit plans have largely disappeared, and our personal savings are subject now to lower interest rates and volatile markets. Even the government is scaling back on old age security, gradually shifting the age of eligibility from 65 to 67. How you want to retire will largely depend on how much money you're saving during your working years and how you continue to manage that money going forward during your retirement. You can look at today's session as a toolbox for managing your finances now that you are retired. Let's take a look at the agenda we have for you today. First, we'll talk about the importance of managing your retirement, and then we'll discuss budgeting tips and how to use that for future planning. Then we'll discuss common retirement strategies, and then I'll end off with leaving you a list of tools and resources for further details if you would like. Managing your finances in retirement has never been more important than it is today. We are living healthier, longer lives than any generation in history before us. What that means is that you will need more resources to fund your additional years. As I mentioned in my introduction, the government benefits today are likely not sufficient enough, and you will need supplementary income to help you maintain your lifestyle that you're used to. Moreover, ongoing changes to the financial landscape is causing the change from historically defined benefit plans to be replaced now by defined contribution plan. I'll talk a little bit more about those in the next couple of slides. What that means for Canadians is that we will need a higher level of financial knowledge to ensure that our retirement plans are adequate. To enjoy life to your fullest in your golden years, you will need enough income to do what you want and also to ensure you could properly be cared for when you encounter any health issues. Exactly how much income you will need depends on what you want out of your retirement. To start our retirement planning, we should consider each of these three questions. You should be asking yourself, number one, are you getting all your benefits? What this refers to is you're looking at all your income sources, which we'll talk about in our next slide. Second, what discretionary spending can you do without? This refers to your expense level and how you can perhaps reduce your expense level to leave more money for retirement enjoyment. The third question is, looking at the horizon of what you're expecting, how can you stretch your financial resources to ensure that it meets your retirement planning goals? Let's take a look at each of the sources of income that you may rely on. There are three major categories. The first is the government pension benefits. It's important to note that government benefits are not automatically applied. In fact, you need to enroll in them 6 months in advance. You may consider deferring government benefits such as the CPP, so that the longer you defer the receipt of the CPP, the higher payments that you can expect to receive. Keep in mind, as a retired person, you are still subject to paying taxes on income you receive. So the level of old age security you can expect will also depend on the income level that you're at. We'll talk about withdrawal strategies in a couple slides later. The Guaranteed Income Supplement is a special benefit for seniors who are low income, and they supplement the old age security. But you must be eligible for OAS and have to separately apply for the GIS benefit. A second source of income for your retirement comes from employer pension plans. These may include money from the defined benefit plan or defined contribution plan. The difference is, for a defined benefit plan, the amount of pension is guaranteed and funded by the employer. As I mentioned earlier in the introduction, this type of plan has virtually disappeared and now been replaced by a defined contribution plan. This is where the amount of pension depends on the results of the investment, and the employer is not responsible beyond their regular contribution to the plan. The third type of retirement income you may upon comes from personal savings and investments, and these include RRSP, TFSA, and non-registered savings. We're going to spend the balance of our presentation focusing on these types of investments. The RRSP is one of the most popular tax savings vehicles. It allows you to reduce your taxable income and allows for any interest income or capital gains to be shielded from tax until withdrawn. Now, this is key. Any withdrawals from RRSPs are subject to your highest marginal income tax bracket. That's what makes timing your withdrawals very key. Look at your government benefits or your employer pension plan receipts, and especially in the first year of retirement, make sure that those withdrawals are not placing you in an extraordinarily high tax bracket so that you're paying hefty tax bills. It's important to note that RSPs are converted to RRIFs, or Registered Retirement Income Funds, at the age of 71. This is an automatic rollover, and that will also cause you to have to withdraw from these funds on a monthly basis going forward. We're going to talk a little bit more about this in later slides. A second very popular tax savings vehicle is the TFSA, or Tax-Free Savings Account. This plan, unlike the RRSP, does not reduce your taxable income. However, any after-tax dollars saved within this account can be used to purchase investments, and if those investments gain value over time or you receive interest income, those are not subject to tax. It's also important to note that any withdrawals from TFSA are tax-free. Therefore, it is a great plan to use your TFSA in the first year or in a year where you're still in a high tax bracket, since any withdrawals from TFSA are tax-free. The last type of personal savings investments are non-registered savings. These include things like personal savings account, investment portfolios, and annuities. Non-registered savings complement what you're receiving from the government or from other pension plans. Non-registered investments include such things as stocks, bonds, mutual funds, segregated funds, and annuities. Segregated funds are mutual funds sold by insurance companies, and annuities are guaranteed income streams purchased by an individual from a financial company. We're going to get back to the topic of annuities a little bit later in the presentation. I sometimes get asked about reverse mortgage as a source of retirement income. A reverse mortgage is actually a loan against the equity you have in your home. So the interest on your reverse mortgage accumulates and the equity that you have in your home decreases with time. If you sell your house or it's no longer considered your principal residence, you have to repay the loan and any interest that has accumulated. Be careful, as taking more debt at the latter stage of your life is not a great plan. We've talked about where your money is coming from. Now it's important to understand where your money is going and whether those align to your values and goals. I'd like for you right now to pull out the handout called Values Validator. This exercise will help you determine the things in life that are most important to you, and when you compare it with your actual budget of where you're spending money, it'd be interesting to see if you're actually spending money on the things you care about most. So on this document, we have a list of about 20 items, and beside it, the exercise objective is for you to place a rating in terms of importance out of 10 on each of these 20 items. The highest score, hopefully, should align with where you're spending your money the most. Now I'd like you to take out the handout called My Expenses. This is something you can complete on your own time, but the whole point is to review the type of expenses you're spending and categorize them in 4 groups. The first group is looking at fixed expenses. These expenses include things like housing payments for a mortgage, car payments, condo fees, expenses that generally stay the same from month to month. The second category expenses are variable expenses, and these expenses can change based on consumption level. So costs that come under this category include costs for food, transportation, electricity, etc. The third category falls under discretionary expenses. These are expenses that can change based on an individual's discretion. And so for things like going out or buying gifts that you don't really need, but maybe you just want. And the last category of expenses are for things that fall under periodic frequency. And what that means is these are regular but less frequent than for vacation. I mean, we all probably want to go on vacation at least once a year, right? After working with the budget for a few weeks or so, I want you to compare your actual flows to your budget. Your actual cash flows will often vary from the budget. That's quite normal, but by analyzing the reason for the differences, you will be able to make changes to what you spend your money on and adjustments to the next month's budget. As a general principle, you should try to draw funds only as they are needed, because you need to remember that well-invested funds take time to convert to cash, and so it's important to plan ahead. One of the scary questions to ask when retirement planning is to see how many good years you think you'll have. Do you think you'll need additional support in terms of long-term health care? Will you move into a retirement home or stay with family? It's important to ask these questions because it will impact the amount of money you can use every year. What you see on the chart right now is data from Statistics Canada gathered between 2007 and 2009 on the average lifespan between a male and a female. There are obviously many factors that affect life expectancy, such as your lifestyle, family history, existing health issues. Let's look at some ways on how to stretch your retirement income to ensure that they cover your lifespan. There are generally 3 goals you need to keep in mind for you to stretch your retirement resources. The first is to generate income, then to minimize taxes, and then you want to protect your assets from inflation and fraud. Retirement is not the time to take huge risks with your investments. It is generally considered prudent to keep the portion you plan to spend of your portfolio in low-risk investments. So these might include such things as the Guaranteed Investment Certificate, GICs, and corporate bonds. Now, these 2 investments are not meant to really grow your wealth hugely, but in fact, it's meant to protect against inflation. It's also advisable when you're purchasing bonds to perhaps ladder your investments, which means to make those purchases over different periods of time so that as the bond matures, you will be able to reinvest that at the current interest rate. A second method to stretch your retirement resources is to purchase dividend-paying stocks, which are slightly riskier than their low-risk investments. However, just be sure to look for well-managed, profitable companies in stable industries. The third way you may consider to stretch your retirement income is to purchase annuities, which will provide stable income with little intervention. The amount of income they produce is largely dependent on the interest rate at the time of purchase. So as a result, financial advisors generally suggest 2 methods in purchasing annuities. The first is they suggest you to purchase annuities once you've reached the age of 70 or later. The reason for that is because the later you buy, the shorter the period that the insurer expects to pay you, and as a result, those payoffs are higher than if you were to purchase them earlier when you were younger. A second strategy is to purchase them gradually to smooth out any fluctuations in payout rates. Because as I mentioned, the amount of annuity income you received is linked to the interest rate at the time of purchase. There are many different annuity options available. It may be useful to discuss annuity investment purchases with an unbiased financial advisor to obtain the most current information. Our second goal is to minimize the amount of taxes you will need to pay in retirement. This is particularly important because at 71, seniors are forced to take minimum withdrawals when they convert RRSP money to RRIF or annuities, often putting them in substantially higher tax brackets. One strategy for reducing the amount of tax payable is to take a balanced approach on the withdrawal of funds from RRSPs and other non-registered savings investments. The Canada Revenue Agency allows for several credits, some of which include the personal tax credits, and as a senior, the age credit, pension income credit, and other tax credits. All of these credits combined allow you to build a room that you can receive income without paying taxes on. So if your annual income works out to be less than your allowable tax-free exemption, so for example, around $30,000 range, you may consider withdrawing the difference from your RRSP or RRIF funds. You will still not be able to pay tax in the current year, but you will have shielded yourself from some of the tax payable on future mandatory RRSP or RRIF withdrawals. A second way to minimize your taxes is to consider pension splitting or CPP income splitting. If you or your spouse is in a lower bracket, you are able to report up to 1/2 of your pension income on your spouse's tax returns. thereby helping you save tax as a couple. Moreover, if you and your spouse are at least the age of 60 and one or both of you receive CPP benefits, each of you may be able to split your benefits with the other, which can save tax if one of you is in a lower tax bracket. A third way you can consider to minimize your taxes is to ensure you are applying for all the applicable federal and provincial tax credit benefits that you might be eligible for, which could include disability and medical care credits. Of course, this depends on each individual situation. If you feel it would be beneficial for you to get personalized support in determining how to stretch your retirement resources, a retirement planning professional can evaluate your specific situation to help you determine your tolerance for risk and identify the various investment and savings vehicles available to you. In addition, they can also suggest and implement tax efficiency strategies to maximize your returns. Now, before leaving the topic of tax management strategies, I want to mention another one that will not directly benefit you, but rather your heirs, and that is preparing your will. By doing some estate planning now, you can ensure that as much of your estate as possible goes to your heirs and not to Revenue Canada. This is because once you pass away, you are deemed to have disposed all of your capital property at fair market value unless transferred to your spouse. Capital property includes things such as investments, your cottage, investments in stocks, bonds, and real estate. If your capital property has appreciated significantly since the time that you acquired it, your estate may be subject to pay significant taxes, thereby reducing the assets available to your beneficiaries. The resources section of this presentation will provide you more information about estate planning. Earlier, I mentioned the importance of protecting your assets from fraud. This is a significant issue for everyone, but especially so for seniors. After all, these are your life savings. And that is why CPA Canada actually has an entire other segment called Fraud Protection for Seniors that goes into more detail. According to the Canadian Anti-Fraud Centre, the top 3 scams reported include fraudulent services, prize pitches, and grandparent scam. Fraudulent services might include things like telecommunications, internet, finance, medical, insurance, and sales services. Basically, whether they call you on the phone, knock on your door, or send you a letter, these fraudsters are trying to make you pay for something you probably don't even know you needed. So make sure you're dealing with a very reputable organization before becoming involved in transactions initiated by someone other than yourself. Prize pitches is another popular scam carried out on the telephone. If the caller might start out by saying, "Congratulations," and then you soon learn that to collect your prize, you will have to purchase a product first, or you'll have to share some personal information or pay a fee. As the old saying goes, if it seems too good to be true, it probably is. There are many variations on the prize pitch that might come in a number of guises and are often done by email, but one of the most popular ones you may have heard about is the Nigerian scam letter. Here you are led to believe that it's a plea to save exiled royalty and that your initial investment stands to net you a percentage of a vast fortune that will also serve to alleviate human pain and suffering. You will soon discover, however, that your percentage is 0 and that the fraudster is the only human to benefit from your generosity. If you establish a relationship with the criminals and send money, they will either keep coming back, or if you show signs of impatience or suspicion, they will sometimes simply disappear. The third type of fraud to watch out for is called the grandparent scam. You get a call from someone who purports to be a family member or friend, urging you to urgently send money via a money transfer company. Are you certain you know who the other person on the other line is? These type of scams are designed to part you and your money. But there is another fraud that can be even more costly, and that is identity theft. In fact, CPA Canada offers a comprehensive fraud protection for seniors session that can cover more details if you'd like, so make sure to request it at your next session. Finally, the last part of our presentation will look at common retirement strategies. There is a common misconception that you have to maintain the same budget year after year in retirement. But that simply isn't true. The first decision you have to come to is the lifestyle you will have. Will you be traveling around the world, or are you happy just reading in your library? We don't all have the same dreams, and depending on our goals, this will impact the amount of dollars we need to save. We can think about retirement in 3 stages: spending, maintaining, and waiting. In the spending phase, this is where the first time you're not working and you have tons of free time. You're healthy, you're active, and in good shape. So this is where the majority of your spendings will happen, as a new life brings new excitement. You should spend more here actually, because as your health declines, even if you wanted to take a trip around the world, sometimes you may not be physically fit to do so. In the maintaining phase, this is the period where you slow down. You've accomplished your bucket list and you've done the things you wanted to do, and now you're more interested in a quiet life with the need of spending significantly declining. The last phase of retirement is called waiting. In this phase, costs tend to increase because perhaps additional costs is meant to deal with mental and physical incapacities, and medical costs, as well as potentially living in a long-term healthcare facility, will drive up costs significantly. The average cost of a long-term care home can vary greatly from $2,000 to $6,000 a month, but generally those retired budget far too much. In reality, at this point, it's expensive, but it goes back to a question of time, and in most cases, it isn't a very long stretch you have to maintain. In this slide, we'll take a look at how your investments should reflect the 3 stages of retirement that we just discussed. Now remember, the 3 stages include spending, maintaining, and waiting. So the funds for your spending years, you want to keep your money in a low-risk investments such as the GICs that we've already covered in an earlier slide. These funds are really for use in the next 3 to 5 years, so you want to ensure that you're protecting your principal as much as possible and that it could weather any significant changes or risk in the financial market. In the maintenance years, you can take a few more risks here, such as stocks and bonds that are geared towards growth in the longer term. This is for use in the next decade, and it's important because this fund will protect you from inflation where your costs may grow faster than your assets. With 10 to 15 years to work with, one can assume more risk, but keep in mind that there is a risk. Always have a discussion with your financial planner about the risks and make sure to voice your particular risk tolerance level. At the end of the day, this is your money and you want to feel comfortable on how it's being managed. Now finally, in the waiting years, this pool of funds can take on even more risk than the maintenance years, and hopefully the growth potential will correlate with the risk. This serves a few purposes. First, you're going to have a backup for your invested funds for your maintenance years, almost as a safety in case something happens. And second, hopefully if the investment grows in the long term, you may leave a legacy either to your heirs or charity of your choice. One of the scariest stories we hear are about those in retirement spending significant money to support their adult children. Some have taken on additional debt to help deal with renovations or home ownership. But be warned that these decisions can cripple your retirement plan. In the end, you may do more harm to your children than help them. Any debt assumed by the estate would have to be dealt with, and it will greatly change the lifestyle you may have envisioned for yourself in retirement. Other areas to consider include estate planning, medical planning, and decision-making authority if you suffer from cognitive decline. You need to make sure that you have identified your rightful powers of attorney and people that you can count on if things decline in later years. CPA Canada offers an estate planning session, so make sure you request it for your next event. We've covered a lot of ground today in our presentation, and so for that reason I left you a list of tools and resources that you can refer to for more details on the topics we've covered. At this moment, I'd like to leave a couple minutes for the Q&A session if you should have any questions that I can help you address. Thank you very much for your time, and I hope you enjoyed the presentation as much as I enjoyed giving it. Thank you.